Hi, everyone. This is Jason Bjork of Wall Street from Main Street. Welcome back to another Wall Street from Main Street podcast interview. Today's special guest is a first-time guest, but you can see his interviews on Kitco every couple months. He's worked in the securities industry since 1979. He is co-chief investment officer and partner at Evergreen HaveCal, the host of the Haymaker Newsletter that has been published since 2005 and now has 9,000 readers, the author of the 2021 book Bubble 3.0. David Hay, thank you for joining me.
Thanks, Jason. And just to be clear, we've got a few more readers or subscribers now. We're up to about 14,000 subscribers. We typically have 16 to 17,000 readers each week. And our partner firm is GovCal. Gov rhymes with Mauve or Suave. And that's important because GovCal is one of the finest macroeconomic research firms on the planet. Most of the big money managers are clients of GovCal: Louis Gov, Charles Gov, Anatole Koletsky, the triumphant trio. But thank you very much. First time to be here, as you said, and I'm excited about it.
So I want to ask you about these 12 months of Fed rate hikes. Do you think the pain is finally just starting to be felt by a lot of these asset prices and companies as they look at their balance sheets and interest payments on the debt?
Well, I don't know if I'd say just starting to be felt, because obviously these losses that are now coming out have been accruing for a while. But this is what a lot of us warned the Fed about. I was, just to give you a little background, for 40 years, because I've been in business for 44 years, but for most of those years, I was a bond market bull. I was a believer in disinflation. And then we had the pandemic, and then we had I'm sure you're going to want to talk at some point about MMT, modern monetary theory, which is what we did in the wake of the pandemic. Something I wrote about as far back as the spring of 2019, having no idea that we'd be doing it a year later and doing it in enormous quantities. And that's what triggered me to then become very negative on the bond market. 10-year Treasury got down to 0.5%. And even by the end of 2021, it was 1.5%. But throughout 2022, Treasury yields, started to really go postal and inflicting massive losses on the banking system, which that's one of the things that's interesting that's related to your point is the yield curve. And when the yield curve inverts, it creates a very adverse chain reaction. And one of the worst casualties of that is the banking system, because it's for better or for worse, it's built on a steep yield curve where they borrow short and lend long. And as most of your listeners know, when the yield curve inverts, short rates are higher than long rates. So that's just kryptonite for the banking system. So a lot of people say, well, the yield curve, I've heard this virtually every time the yield curve inverts, there's always a certain chorus that blows it off. But it's not just predictive, as we're seeing, it's causative. And it actually can cause a recession by creating a banking crisis. And this was the third most severe inversion that we've seen. Now, again, kind of looping back to what you brought up, I think the big red flag, if you look historically, is what we're starting to see now, which is when an inverted yield curve starts to uninvert. That's when you're really getting the strident recession warning. And we saw that here recently. Now it's starting to reinvert again. So it's not going to be a straight line. It's going to be choppy. But I basically think the yield curve doesn't get anywhere near the attention it should.
And that doesn't cause the damage right away. I think that's what most people don't understand. So there's like a lag effect with an inverted yield curve. There's a lag effect with these rate hikes. So it takes time. It takes 6, 9, 12, sometimes even 18 months for all these asset classes and the businesses to adjust to a new normal of much higher interest rates. And I think we're starting to see even more pain than a lot of people expected.
Absolutely. You're right. And it's a function. This is one of the big topics of my book, is that we created, if you looked at, there were so many bubbles. I really think it was the everything bubble that hit a crescendo in 2021. But arguably, and I don't think very arguable actually, is that if the bubble in the bond market was the greatest of them all, where you had negative yields, it was something like $19 trillion worth of bonds globally that had negative yields, unprecedented in human history. And even the United States, we'd have negative yields. We had very low yields, and they persisted for a very long time. So that's the helium that you pump into all these different bubbles. And it persisted for a long time. So that means these excesses persisted for a long time. And the Fed and the other central banks convinced the banking systems that they were going to keep the interest rates low, as far as the eye could see, at least for a couple more years. And instead, about a year ago, the Fed realized that, they were so far behind the inflation curve that they just had to slam the brakes on. And of course, you got a lot of people hitting the windshield and going right through it. So it's you're right, but I really want to agree with what you said. there is these lags, and because of these lags, it's easy for people to say, "Oh, it's not working this time." And in our business, those are very dangerous words.
Yeah, the lag effect, and then it hits, and then we've seen this. What in Alan Greenspan was raising interest rates, 2007 before he left the Fed, and then Ben Bernanke, I think, continued to raise interest rates. And they said housing prices nationwide haven't all fallen, but there was a lag effect. There was a lag effect with the last Fed rate hiking cycle, 2017, 2018. By 2019, it caused the repo crisis. So the lag effect, there's just proof in just the last 10 or 15 years.
Absolutely. I was just going to say, I think it was Milton Friedman that said that monetary policy works with long and variable lags. It wasn't him, it was somebody else very prestigious, and it's just a fact of life. So I totally agree with what you said.
Yeah, I mean, the housing bubble before the 2008 financial crisis ran years longer than people thought. And then the Fed was raising rates, and then that finally broke the subprime and all the derivatives that are attached to it. Do you think we're going to see something similar play out with commercial real estate and the derivatives that are attached to that, the commercial real estate mortgage-backed securities in this potential crisis?
Well, thank you for going there, because that has become one of my new mega risks, because I'm convinced that commercial real estate is going to be a disaster. And part of that is because of what's gone on with office buildings. Office buildings, I mean, you can just see that one coming. I mean, for example, even though the lease rates are about 85% leased, but they're only about half occupied. And as those leases roll off, I think that's where you're going to see the banks just, it's going to be jingle mail on a very grand scale. These banks will come back. And what's, I think, making this worse is the recent development that we've seen with these bank runs, which have been, of course, on, well, they're not necessarily small banks. Signature Bank and Silicon Valley Bank were the 15th and 16th largest, I believe, banks in the country. But they certainly aren't the systemically important banks like a JP Morgan. But the reality is 70% of commercial real estate loans are held by small banks that I think it's something like less than $50 billion in assets. Anyway, they're considered to be smaller banks. So that's going to be a real problem for those guys. And I do think that has the potential to create another series of bank runs and panics on some of these institutions. So it's a good point. I think it's a very significant risk.
And you were tweeting out recently about the losses at these regional banks because they have to mark to market their securities losses. Unlike some of the large banks or the U.S. federal government, they have to mark to market their losses on these bonds. The losses are already over $600 billion, according to some of the estimates.
Right, which is a big chunk of their net worth. And this one is a shocker. I don't know if you follow Chris Whalen, but he is a brilliant guy when it comes to tracking the banking system. He's been way out in front of this. His comment for months has been, because everybody thought higher interest rates good for banks, which to a degree it's true, but to a degree. And he was saying, look, this is getting so out of control that this is really going to threaten the banking system. So before even the first bank run happened, but his point on a recent podcast he did was that as of the end of the year, even JP Morgan had a negative equity if you marked everything to market, not just their securities portfolio, but their loan book as well. And, they're not going to have to do that. They'll get through it. And there's, the help, you can hold the maturity, then there's available for sale. And the problem that apparently is, I didn't hear this from him. I heard it from a different but credible source that if you hedged, I think it was actually Eric Townsend from Macro Voices, that if a bank attempts to hedge its hold to maturity portfolio, then they have to move it to available for sale and recognize the loss. So it's this perverse thing where you can't actually hedge that part of the portfolio. You can do that with the available for sale. But of course, what a lot of the banks were trying to do is this bear market in bonds really got underway was move them from the available for sale category into hold to maturity. So then, that's okay until you start getting a bank run, and then you get so many redemptions that you have to sell your hold to maturity portfolio, recognize the loss, and take the hits against equity. And so that's exactly what happened to Silicon Valley Bank, SVB. So it's just, there's going to be a very heavy price tag to be paid for the many excesses of Bubble 3.0.
Isn't the Fed also subsidizing these regional banks? So the Fed's already loaning at par, which is 20 or 30% above the value of these bonds that these regional banks are marking to market on the losses. So the Fed's already kind of subsidizing and trying to financially engineer kind of a soft landing for these banks.
Yes, that's exactly right. I think it's the LTVF, so many acronyms out there, but I think that's the one you're referring to. It's definitely where they can put up their bonds that are underwater and get a loan at face value. It runs for a year, but they'll probably extend it as they need to. And if you think about it from even a bigger picture standpoint, it's a way for the government to help incentivize, or at least not disincentivize, banks from buying government securities because they need them. I mean, that's my other big mega risk for this year, besides the global housing bubble bursting, is a potential fiscal funding crisis for the U.S. government, where there just aren't going to be enough buyers to buy all the debt that the government's got to sell right now. At a time when foreign central banks, who used to be very active buyers of U.S. Treasury debt, are sellers. And of course, the Fed itself has gone from buying $1 trillion to selling $1 trillion. So that's a $2 trillion delta right there. And you've got Social Security Trust Fund, Medicare, they're forced to sell because they don't have enough revenues coming in to meet their obligations. And so and then just think about if we do get a recession, which I think we will, what does that do to government revenues? Revenues go down, expenses go up. So you could be looking at a $5 trillion net delta in terms of Treasury issuance, either increased supply or decreased demand. Somebody's got to fill that gap. And ultimately, I think it's going to be the Fed going back to its magical money machine that, of course, they like to call long-term asset purchases.
Yeah, the other theory I've heard is that they have to change the laws for the large banks, and then the large banks are allowed to increase their U.S. Treasury holdings as a larger percentage of their balance sheet. Because right now I think it's around 10%, but in the past, in war times, they stuffed the banks full of even more treasuries than that.
Yeah, I think that's what they're going to have to do for those banks that do have the stable deposit base. I think they will be doing that. But since you went that direction, that's one of the points I've really been making here lately in my writing and my various podcasts, is that the B word is something which I think is being greatly underappreciated. And by B, I mean velocity. Because one of the most famous formulas in finance is M times V equals P times T. And so that really stands for money supply times velocity equals prices times transactions, which is just a way of expressing essentially nominal GDP. So now the reason that matters is because the money supply is now contracting, and velocity had been improving for a variety of reasons. But now with the banks losing deposit, even the big banks, like if you look at it, it's not a pure bank, but they own a big bank, Charles Schwab, they're seeing this phenomenon called cash sorting. And we do this all the time for clients because it's very maddening as a portfolio manager, investment advisor for clients that these sweep funds where, you sell a security for a client, automatically goes into their sweep fund. Well, it's not insured. And if it's a relatively small balance, fine. But your larger clients, you get a lot of money in those funds, uninsured, and it pays virtually nothing. Even with all the rate increases that have happened, they're still down around 0.5%. So for us, we have to go in and manually buy their government fund. And this is one of the craziest things I've ever seen in finance, where you can get a much higher return, go from 0.5% to 4.5, 5 with government securities. Much higher return, much safer. Shouldn't happen. But the implication of that, so Schwab is saying, look, we're getting net money inflows, which is true. But what's happening within the firm is the money is moving out of those sweep funds and into government securities. And when it's in a sweep fund or when it's in a checking account at a bank, it has a very high velocity, or at least it can have. It's high-powered money. So you're moving from basically a high-octane venue to a low-octane venue. And, we're talking trillions of dollars that are in transit right now. There's a few people that have written that up. I saw that Mike Wilson commented on that from Morgan Stanley. He's one of my favorite. In fact, he's my number one big Wall Street firm strategist. Christopher Wood from Greed and Fear Jefferies. So some people are picking up on it, but I think that's greatly underappreciated. But it will manifest itself.
It also seems that there's a lot of cash that's gone into money market funds. Do you think that there's hidden risks in a lot of these money market funds, similar to what happened in the 2019 repo crisis? Because there was money market funds that lent into the overnight repo, and then the repo was the banks and the hedge funds that had borrowed from repo couldn't pay back their loans. So then the money market funds that were the lenders into repo couldn't get their customer funds back.
Well, it certainly could be some high risk. I mean, Schwab had that yield plus fund that went down like 30%. It's a huge lawsuit for them, and I think they had to make people whole on that eventually. So there could be some. I think these funds are so much more heavily regulated now that that's less likely. The other thing, but I think it'll probably still happen in a few isolated cases. But what I think is a big difference here is that the Fed is paying they're able to pay interest on their reserves, and this RRP, the reverse repo plan program. I mean, they're paying 4.5% or so. So what these money funds are doing is they get the money flooding in. If they don't put it into treasuries, and there is a bit of a shortage at times of particularly short-term treasuries, they just go right to the Fed. So the Fed is paying them interest on it. It's risk-free, completely liquid. So that's a no-brainer for a money fund. I did see that Michael Hartnett, who's another one of my favorite Wall Street strategists, is saying that he thinks the money funds are going to be the next bubble. And I think at some point it will be. I mean, if you think about this, if this runs its course, we get a real panic, we get a recession, money continues to flood into these things. At some point, it's going to come back out again, and that could be, really the liftoff to the next bull market. I just think we have another leg down before that happens.
Have you seen any accurate estimates for the commercial real estate mortgage-backed securities? Because I just saw a tweet out in the last week by New York Fed director. The guy's named Scott Reckler. He says there's 1.5 trillion in commercial real estate debt maturing next 3 years. The bulk of this debt was financed when base rates were near zero. Debt needs to be refinanced in an environment where rates are higher, values are lower, in a market with less liquidity. And you said the occupancy rates are so low. This sounds like enormous problems for commercial real estate. What also worries me is all these derivatives that are tied. If commercial real estate does have a full-blown crisis with prices collapsing, then the derivatives that are connected to this would blow up. And I haven't seen any reliable estimates on the commercial real estate mortgage-backed securities.
Nor have I. I'll definitely have my eyes alert for that, because I think you're exactly right. We tend to see the obvious things and can kind of quantify those, but in a world that's so full of derivatives and leverage, it's the knock-on effects that can really be disastrous. And so I think it's a good point. I did see that commercial mortgage-backed securities are at the lowest level they've been since back in 2008 or 9. I mean, basically global financial crisis. By the way, kind of along those lines, even worse, going further back, U.S. deposits are falling at the fastest rate since 1981.
And collateralized loan obligations, which are worse collateral than junk bonds, those also worry me. So the Fed, not the Fed, the large Wall Street investment banks were creating a lot of those the last 10 years.
Oh, yeah. They're good at creating all that dodgy stuff. I mean, as they say, on Wall Street, when the ducks are quacking, feed them, and we always do, or Wall Street always does.
Yeah, I was joking before we started recording that this stuff's toxic sausage, and then eventually it goes to zero, but it's sold to these pension funds as an income product, but then the value of it collapses because it's just so risky, especially in a higher rate environment where people can get a lower risk yield on treasuries or government bonds than these collateralized loan obligations. So these derivatives, unfortunately, the Fed will probably have to end up buying a lot of these things back at full value.
Well, that's right. And that could be why you're starting to see gold perform nicely, even in a high interest rate environment, which is typically tough on gold. Is that I think you're touching on, it kind of relates to what I was saying earlier about one of my mega risks as far as the U.S. fiscal funding crisis. The government steps up and bails all this stuff out. Well, who's going to bail out the government? I mean, really, you don't have the willing sources of funding that you used to have. Losing the foreign central banks is a big, big deal. And it's not just that they're not buying anymore, they're actually selling. And what they're doing with the money that they're raising is they're buying gold. Last year was the second highest central bank purchases of gold on record. So that, and then you also talked about pensions. And so my brilliant partner, Louis Gov, would be a good guy for you to have on your show. That's what he thinks is the ultimate whale. Gov-Cal's used this analogy for decades, really, about when you go through a crisis, it's like dynamite fishing. At first, the minnows come up, and then eventually there's a whale. And I don't think he could say that Signature Bank and SVB, and even if First Republic fails, that those are the whales. I mean, they're pretty big fish, but he thinks that the pension funds in America are really in tough shape because they have done so much of this aggressive stuff trying to goose returns, which is another function of when you have interest rates held at artificially low levels for a very long time. So to try to get enough yield to meet their pension obligations, these entities like, let's say, CalPERS are doing all this funky stuff, and eventually it blows up. So, they've got a lot of exposure to commercial real estate. And I think right now the zeitgeist on Wall Street is that the worst is over of this latest kind of mini banking crisis. But I don't think so. I think more and more of these things that you're describing are going to continue to come up. And as people get bullish and complacent, I think that's what creates these really violent downdrafts.
And before we started recording, you said that in your thoughts that there's a global housing bubble that is actually larger than the problems in the U.S.
Unquestionable. When you look at these Nordic countries, well, part of the problem gets back to these negative yields, which then trigger these enormous real estate bubbles. So in Denmark, if you wanted to buy a home at one point during that paradigm of negative yields, the bank would have actually paid you to take out a mortgage. So what did that do to the price of real estate in Copenhagen? I mean, obviously it went nuts. But even in Canada, where you really didn't have negative yields, you just got very low yields, much, much more. If you look at housing prices relative to income, if you look at debt levels, individual debt levels, they're far higher in a lot of these countries, like Sweden. Also, Sweden housing prices are already starting to come down at a double-digit clip, but New Zealand, Australia as well. It really was another global bubble, but at the valuations got much higher than they did back even at the peak in '07. So and there's more debt underlying that. And that's why I'm just amazed at how cavalier the financial markets are after the experience that we had last time. And you would think this banking, because I mean, I wasn't worried about a lot of stuff. I wasn't worried about bank runs. To me, that was surprising, and especially the speed with which it happened. So I just think this has been a big wake up call. Maybe it's kind of like what happened with Bear Stearns in the spring of 2008 when it first went down. But I don't know. I don't think it's over. I think there's still more cockroaches out there.
And the other countries you just mentioned, so Australia, Canada, New Zealand, those places are where a lot of where a lot of hot money from China went in over the last 10 or 15 years to buy up prime properties.
Sure. Oh yeah, Canada, Western Canada. They call it Vancouver instead of Vancouver.
And actually, I wanted to get your thoughts on the Chinese economy and the Chinese housing bubble. So it looks like the People's Bank of China, their central bank, is going to have to do similar measures to what the Fed did during our housing bust in 2008, 2009 to save their banks. Do you think that that's probably what's going to happen?
Yes, I think they're masters of sweeping things under the rug, kicking the can, whatever. I think they will do that. And there's a lot of, well, unlike in America, where we're kind of saving short, and we run these persistent trade deficits. The twin deficits, trade and government fiscal. They have a little bit of fiscal deficit, not anything like ours, but then they have big trade surpluses, and they have a lot of a very high savings rate country. So they've got the ability to kind of cover up the losses, but the losses are there. And I just don't see how they're going to get anywhere near the economic growth they had in the past, because for one thing, they've got poor demographics, but also they just can't keep doing. I mean, they've built that country out, whether it's apartment buildings, condos, or bridges and high speed trains. And so it's not going to be, and this is where I do have a little bit of a disagreement with my dear friend Louis, who's very bullish on the China reopening. And I think it's a positive. I think it's mostly a positive for oil, where I'm extremely bullish, though it's been rallying like crazy here recently, but it's still very, very cheap. And I don't know if you care about energy, but I think there's really a great opportunity in energy right now after this big correction.
It looks like over the next couple of years, there's going to be a global government debt crisis, because I'm just running the math, whether it's Japan, the United States, as you talked about earlier, all these other countries, they increased the government borrowing, government debt. They handed out stimmy checks over the last 2.5 years. And now the price is coming due with the higher interest rates. So I just see a math problem on interest payments on government debt going forward.
Precisely. And I think where that math problem is really profound is in the United States, because a number of these other countries do have other funding sources. A lot of it's domestic. We don't have that. I mean, we have some domestic savings, but not nearly enough. Or if it all goes to the government, what's that going to do to funding the private sector, which is rather important? It's something like 70%. If the deficit, let's say we're running a $2 trillion deficit at some point, annualized here relatively soon, because we're in another downturn, that would use something like this, according to Luke Groman, who studies this really closely, or Forest for the Trees, that would be 70% of available private sector in the world. That's how much it would consume to finance the U.S. deficit. And I can't verify that. He's a very bright guy, so I think he's probably at least in the ballpark. But if you then start thinking about these other countries being in kind of the same boat, then they've got to suck in their domestic savings to their their public sector. And so you could be in a real funding starvation situation for the private sector. And that's not good. That's the engine of growth, not the government. Although
Yeah,
they try to think that they are.
it sounds like the central banks are going to have to start monetizing debt. It sounds like the over the last like 12 months, these central banks, at least the Fed's narrative was they were reducing their balance sheet over the last couple of weeks. The Fed's balance sheet, and we're recording this interview on Thursday, March 30th, 2023, for our listeners out there. Just in what, 2 or 3 weeks, the Fed's balance sheet, it already rallied enormously compared to the quantitative tightening, the balance sheet reduction that was done. 2/3 of it's already back on the balance sheet.
Right, and that's a lot of that's due to the discount window, keeping the banks going, and so they come to the Fed and they go to the discount window. But in fairness, it is different than QE, which was basically free money because they're paying a penalty interest rate to get that money. So it is, I'd say it's kind of QE light. That's actually a fairly hot topic within GovCal, where some people think it is. It's QE's already restarted, and some think that I think the truth is kind of in between.
It reminds.
Regardless, I think you're right. I think that's the end game. That's what's going to happen at some point. Is the Fed is going to have to restart its magical money machine.
Jerome Powell's speeches recently remind me of almost exactly what he said during the repo crisis in October 2019, when the Fed's balance sheet increased by about $1 trillion in 2 or 3 months, because he was saying it's not QE back then, even though the balance sheet was expanding. So he was like, oh, we're lending out, we're buying stuff as collateral. And then they just kept extending the terms of the repo loans longer and longer and longer. And then it was added to the balance sheet.
Yeah, and then COVID hit, and then they went into MMT mode. So yes, you're right. In fact, I often write that I consider that to have been QE4, the repo crisis thing, which didn't go away, right up until when COVID went viral, literally.
So if the governments go to debt monetization or hyper Keynesianism or MMT, do you see a supply side problem for some of these commodities over the next 3, 4, 5, 7 years?
Absolutely. And then you've got what I call the great green energy transition. This idea that we're going to be able to put millions and millions, tens of millions of EVs on the road over the next 5 years or so. And I realize that's a very controversial topic. And some people, if you say maybe that's not a great idea, they get really upset and they'll send you nasty emails. And I would just say that, consider the track record of policymakers in recent years and how well they have or haven't handled kind of these big issues and crises. And I don't think it's a very impressive track record. And I think you're already seeing some real problems with this great green energy transition, which feeds something I've been calling, I think I was the first one to throw this term out there, greenflation. It's just very expensive to be moving, global, at least in the West. This is, of course, not nearly as true in Asia and Africa. I mean, they're smarter than we are, frankly. They realize that, and they also are in some ways poorer. They don't have this luxury, or at least this perceived luxury of wealth, to be able to do this unbelievably expensive move away from high density energy sources to low density energy sources, which is what we're trying to do for the most part. And it's, we're already seeing that it just doesn't work. And part of the huge problem from a geopolitical standpoint, with all the turmoil that's there and all the confrontational things that are occurring, is how much of the EV and just in general green supply chain is controlled by China. And here we are, you could argue the U.S. is actually now a net energy exporter if you look at both oil and gas. I realize we need to import heavy oil because our refining complex needs heavy oil. And by the way, the overseas markets love our shale oil because it's so that's why when these trains with shale oil go off the rails, they can literally explode. It's almost like gasoline. So for these teapot refineries in China, they love our crude, but ironically, our refining complex doesn't. But putting that kind of nuance aside, we are essentially energy independent. We're a big natural gas exporter. Who would have thought that 15 years ago? So here we've got this kind of gift, given to us by these guys that have been demonized down in Texas for fracking, and we're at risk of frittering it away. So I just think, there's not to say. I'm a believer in solar, and we've got where I'm sitting right now, the home in Indian Wells, California, has got solar panels on it that we put in about 10 months ago, and I think the wind's got a place, but I think they're more fringe sources. I don't think they're great base load power sources. I do think what's happening at a fairly quick clip is a shift towards small modular nuclear. And I'm really bullish on small modular nuclear. I know you had Rick Rule on here recently who's forgotten more about nuclear energy than most of us have ever learned, myself included. And I didn't hear all of it, but I've heard him in the past where he does think that nuclear is going to have a major renaissance. So that's one of the reasons we love uranium, which I think most of your listeners don't have in their portfolio. And you can definitely do that through Sprott, which I think Rick is retired from Sprott, but he was one of the key people there. But they've got this SRUUF in the U.S., and that's the Fiscal Uranium Trust. I think that should be a portion of everybody's portfolio.
Yeah, I think there's a global energy crisis, even though natural gas prices have crashed recently. I think that's just short term because I think supply will come offline. And then the US is going to be exporting a lot more liquefied natural gas over the next 5, 10, 15 years.
Absolutely. One of the reasons that it happened, that glut of natural gas, I mean, we had a warm winter, somewhat warm winter in the U.S., although not in the West, I'll tell you that. It's still snowing about 20 miles from where I am here in the desert. And, unbelievable amounts of snow in Lake Tahoe. But for most of America and certainly Europe, it was a mild winter. So that definitely worked against naturally. It was a gift from God, really, to the Europeans. But I think they're getting a little complacent again, and they're going to have to refill that storage. But the other thing, the Freeport export facility went offline, down in Texas, and that's about 20% of U.S. exports. So that's now back online, kind of gradually. So that's going to increase. But you're right, there's a lot of other stuff that's being built out, and U.S. natural gas at $2 per million British thermal units is just an unbelievable bargain. It is interesting how if you go out to December of 24. That's trading for about $3.70. So very, very steep, what you call contango, going from the spot month to a further out month. Unlike oil, where oil, it's actually the other way around. It's in backwardation, and that's one of the greatest bargains in the world right now is to be able to go out there, for 9 months and buy oil at $68 a barrel. I think that's just absolutely nuts. Oil inventories the SPR releases have scared this, but globally and in the West, where so much oil is consumed, our inventories are just shockingly low, dangerously low.
So since you've been managing money for so long, over 40 years, is this one of the most difficult environments of your entire career?
Not really for me and our team, the way we approach things, because we tend to do well when there's a lot of volatility. And we've had a lot of volatility with actually kind of a downward bias here I would argue that kind of the peak insanity moment was sometime in mid 2021. So it's been almost 2 years now of the bursting bubble, which is really kind of a very advantageous environment for us. Where we struggle is when we're just in a market that becomes just a bigger and bigger and bigger bubble, and we're constantly, reducing exposure, and then you start underperforming, and people get restless. And so this is actually kind of nirvana for us. I think if you're an active trader, and I would say green here for a while, and I think there are going to be some great trading rallies, which we actually saw recently with bonds. But in general, I think it's going to be other than with things the Fed can't print, whether it's oil, natural gas, copper, uranium, wheat, some agricultural products, fertilizers, things the Fed can't print, and where there's an inherent scarcity. I think those are long-term holds. But even there, when they go, they typically get these explosive moves that come out of the blue. I think you got to take at least some profits, and they'll sell off again. I don't know. Have you ever seen the price of gold in the Weimar Republic, Germany, in the early 20s? Ever seen a price chart of that?
No.
And here was the biggest currency collapse in modern history, and yet gold had some just absolutely terrifying declines. And then, of course, it would go up even more, and eventually it went completely vertically asymptotic when the currency completely collapsed. And it's interesting how they got out of that. I think that U.S. policymakers would be well served to go back and study how, because that's when Hitler first tried to take power, when they had that hyperinflation. But they got a finance minister in there who figured out how to restore faith in the mark that had to be completely redesigned. They issued a new mark that was backed in their case by real estate. That's about all they had. They didn't have any gold. In the United States, we are so blessed with abundant natural resources and immense land. But I think that's where we're going. I think we're going towards a dollar that's backed by a basket of real assets, versus this fiat currency that they can create at will and have by the trillions.
So do you think there's a gold bull market that's starting over the next couple of years, and a lot of it's because of these central bank purchases that you were talking about earlier in the interview? You think that's going to be a long-term trend then? These countries are going to be diversifying away from the dollar and buying commodities and net tonnage of gold?
Yes, they clearly are, and I do think gold continues to be in a long-term bull market. You could argue about when did it start. It's made a couple of all-time new highs here fairly recently, and then pulled back sharply. And I am worried that it's a little ahead of itself on a near-term basis. So I would, we are actually taking a little bit of money off the table, but we still have a lot more money, almost nothing in the index and the S&P. So we're way overweight relative to the S&P still. But I like to be in something which is in a clear bull market, let's say energy, and where there's been a big pullback. That's, to me, the safest way to play that and be willing to take profits. I think people that, you see this all the time with crypto, they get in early, they make a ton of money, and instead of doing kind of a systematic profit taking type of a program, they buy more and more the higher it goes, and then they end up actually losing money, even though their original purchase was brilliant. So I really believe in trading around a core position. So if you're at 5% and you go, it doubles and now you're at 10%, get it back down somewhere close to where you started and just keep repeating that process and you make a ton of money. And that way a bubble is your friend. Unfortunately, most people get crushed by bubbles because they get enamored by them and they put more and more capital in it at very inopportune times.
Yeah, I agree. Retail investors tend to buy tops and sell bottoms.
Mm-hmm. Absolutely. In fact, we call that wrong cycle investing. We've even developed, this goes back to almost 20 years ago, called right cycle investing, which is our ETF strategy where we track, and we're the only ones that do this as far as I know, we track mutual fund flows and we see the retail investing herd, just like a couple standard deviations above normal going into a particular asset class or sector style, whatever, and valuations are really over, way over a normal, we'll underweight that particular style or sector. And conversely, when there's a lot of negativity, outflows, extreme outflows, we look for extreme readings, not just, a little bit this, a little bit that. And it works, but it doesn't work instantly. And for a lot of people, they want the instant gratification. That's what makes bubbles so dangerous, is that you can warn somebody and say, oh, look, this is crazy. Look at this chart. It's just straight up. And it keeps going straight up. And they say, oh, what do you know? And I'm smarter than you. And then the bottom falls out. The trap door opens up.
So speaking of bubbles, since you just published your Bubble 3.0 book in the last couple of years, is there any other bubbles you think that these governments or central banks can create, or are they running out of options?
Well, that's a very good point. I mean, I think you could make the case that they will try to do that with gold. So there is a school of thought. And if things get tough enough, I think the school of thought could turn out to be true, is that the central banks, let's say the Fed and the Treasury together will mark up gold to say $10,000 an ounce, because we do own a lot of gold. If you get the price of gold up high enough, then you can say our debt is now guaranteed by our gold. I've heard somewhere around 10,000 could do it. I don't know if that's right or not. Maybe it needs to be 20,000. And you would think, gosh, if I'm a holder of gold, that's going to be just fantastic. But I do worry that they could do some kind of windfall profits tax against holders of gold, or make people turn their gold in, which happened in the 1930s, and then mark it way up. And I think one of the things that as you look, even what happened here recently with Credit Suisse and UBS, and that's obviously in Switzerland, but just in the West in general, we're playing really fast and loose with the rule of law. We're breaking contracts. People will vote a certain way, like in the state of Washington, and the legislatures decide to do the opposite of what the people have voted for repeatedly. I'm talking about a new tax that's been put in, but you just see that happening time and time and time again. And that used to be and this is a big theme of Louis Gobb's, that used to be the West's big comparative advantage, was respect for the rule of law, as opposed to, say, China, where the rule of law is whatever Xi says it is, or Putin in Russia. But I don't know. It seems like we're kind of going their direction, and I don't think that's healthy.
Yeah, I call it stagflate tax lie, and the lie component is exactly what you said. It's the goalposts moving, it's the rules changing. So the bailouts, they pick and choose winners and losers. They're changing the definitions of inflation. I mean, a lot of the financial statistics with GDP, jobs, inflation data, it's tweaked all the time. It's adjusted or tweaked all the time now.
Absolutely. And as you know, the Fed is just recently, actually, it's not fair to say the Fed, I think it's the Bureau of Labor Statistics that's changing the inflation calculation, which ironically for a while is going to make inflation look a little hotter. But over time, I think it will make inflation, it will tend to underreport inflation. That's certainly happened in 2021 and 2022 because of housing. They were showing very little housing inflation at a time when housing prices, were up 20% year over year. That's owner's equivalent rent. Now they're kind of paying the price of that because it's staying, it's actually now making inflation a bit worse than is it like. I mean, you have falling rents, and yet with their calculation, rents are increasing. And that's another area where I have worries because where there's been a lot of overbuilding is with multifamily. So I think that's going to be another nasty shoe to drop to digress a little bit.
Yeah, I think one of the last bubbles the governments are trying to create is a green energy and ESG bubble, but I think it's unfortunately going to create supply side problems for conventional energy. So for nuclear power, coal, oil, natural gas. I know a lot of these countries are putting out press releases saying we're going to build a liquefied natural gas import facility, but those same countries also have oil and natural gas drilling bans. So I guess they're magically assuming that natural gas supply is just going to appear. It's the same for these electric vehicles, David. I don't think there's enough copper or silver for us to switch all these electric vehicles in only 5 to 7 years to switch from internal combustion engines over to electric vehicles. I don't think there's enough copper or base metals, copper, nickel, and silver.
Absolutely, I agree with you. And then throw lithium in there too. And that actually is another area that we like because there's been a pretty big shakeout in things like LTHM is the ticker symbol. So I think I guess you could say, look, this isn't going to happen. So if you buy these companies, even copper producers, you're going to be disappointed because even Europe's kind of backing away from this ICE ban thing. But I do think there's enough movement and political momentum behind it that we are going to see a lot more EVs on the road 5 years from now than we have today. But I don't think we can hit the numbers that the politicians would like and the environmentalists would like us to hit for the reasons you mentioned. It just can't happen, at least not without prices going absolutely nuts. And the problem is, okay, we'll go out and develop more copper mines. Good luck with that one. And they fight that tooth and nail, and then you get the grid. The grid is already very fragile, even in the United States. And if you put millions of more EVs that have to be charged on the grid, if somebody's got solar panels like I have, well, that's I think that's good, but that's going to take a long time to get enough of that to be really critical mass. But in the long run, I think that could be a big source of reducing the demand for oil for transportation. But it's not going to happen nearly as quickly as our beloved policymakers would like it to happen.
Our electrical grid is also not modern enough and not efficient enough to move the electricity back and forth to different states. So it's not efficient like that. I mean, it would break down. It's
totally. And you look at the fights that have been going on in the northeast part of the United States where there's excess hydroelectric power in Canada, and I think it's Hydro-Quebec, and for like 15 years, they've been trying to get transmission lines to bring that to the Northeast, where power prices are very expensive. They're like double or more what we have here on the West Coast, at least in Washington. The state of Washington, California, where I'm sitting right now, is more like East Coast. But and they have all that natural gas that's just a few hundred miles from those big markets in the Northeast, and yet they won't allow new pipelines to be built. Or you may know about the Mountain Valley Pipeline that's 95% complete, and it's been delayed for years. And anyway, that's your point is well taken. And this idea that even if you build all these big solar farms and wind farms, but to get that power to market, you have to have transmission lines. And good luck putting in transmission lines.
Yeah, this is not a free market or capitalism problem. This is a problem with policy blunders from politicians, bureaucrats, regulators. They won't allow the capitalist or the free market solution to say we have all this cheap natural gas in the Appalachians there, in the Utica and Marcellus fields that are not far from the Northeast and Massachusetts. All we have to do is build a pipeline and move it. I mean, they're blocking it.
Precisely. It's madness, really.
Well, I think they want people to consume less energy, but then they hurt the businesses and then they hurt jobs and they hurt their economy. So these politicians, bureaucrats, regulators who all want high salaries and want to increase taxes, I mean, they can't keep increasing taxes if the economy is contracting or jobs and businesses are leaving.
No, it becomes kind of a death spiral because the more you raise taxes, the more you drive your tax base away. And that's why some of these states are now trying to resort to an exit tax. But that's really tough.
That's even
No, no
worse.
problem.
That's exacerbating the problem. I mean, they think that they can, what California was proposing that, right? And they want to go back, they want to go back, claw back 10 years worth of tax revenues if you leave the state.
Terrifying. It gets back to what you were saying earlier about moving the goalposts and just constantly changing the rules in a very arbitrary way. And that undercuts trust and confidence. And that a modern society like ours is based on trust and confidence and the rule of law and sanctity of contracts. And
Well, unfortunately, David, this happens if you study financial history and history. This happens at the end of every single empire, whether it's in China, Mongolia, Rome, the British Empire. It happens at the end of every single empire, that the empire is just so bloated and big and corrupt and wasteful. And look at how much we're spending on Pentagon budget and interest payments on the debt. It's just not sustainable. And then politicians think, oh, we could just raise taxes, but that only makes things worse because then the jobs leave.
precisely. No, you're right. You said it's not sustainable. I totally agree with that. It's not sustainable. I
So
think
as
it was
we
Stein's father, Ben Stein's father, Herb, that said I think he was in the Nixon administration, senior economist, and he said, if something can't continue, it won't. One of those just really basic, almost Yogi Bear-like quotes, but it's true. And yet you look at the financial markets, and they're just, I mean, even to have long-term treasuries yielding 3.7%, whatever the exact number is right this moment, relative to all these risks to long-term bonds. I mean, I get them as trading vehicles; they can work for a little while, but I mean, I just think those things. I'm so old. When I first started the business, bonds were called certificates of confiscation because they were just disastrous for so many over. Well, it was basically from end of World War II to when I started the business in the late 70s. They really had been, for the most part, certificates of confiscation. We're kind of back to that now. And yeah, there were some great trading rallies from 1945 to 1981, 82 when Volcker finally killed inflation. But you had to sell those rallies. And the long-term trend was up in yield, down in price. And that's where I think we are right now. So yeah, I think as an advisor, we're at a time where we can just give tremendous value to our clients by protecting their purchasing power as best we can. But I do worry that even when we're right, that the powers that be will try to take away some of our gains.
Yeah, whether it's windfall profits taxes on oil companies, and we've seen a lot of that the last 2 years, especially when oil got to 140, 150, pricing in the geopolitical risk premiums with Russia and Ukraine. There was tons of governments that came out and said we're issuing windfall profits taxes on our oil companies.
Well, it definitely did it in Europe. I mean, they actually implemented it. Here, there was a lot of talk, and then oil prices fell, but it will come back again. And if they're trying to make oil companies feel better about developing new reserves, they're certainly going about it the wrong way.
Oh, yeah, I agree. I think there's supply side problems coming over the next couple of years in a lot of different commodities. But as we wrap up the interview, David, is there anything that you're optimistic or bullish on in the next couple of years?
Well, I've mentioned quite a few things, and I guess what I would say that one thing that I do, so I do a weekly letter called Making Hay Monday that's got specific trade suggestions in it, likes, dislikes, and neutrals, basically. And one of the things that we've heard from our readers, again, we have now just about 14,000 subscribers and about 16, 17,000 readers per week, is that they really like the fact that we give them income ideas. Because I think most financial newsletters, it's growth or it's commodities. I mean, commodities get a fair amount of coverage in various financial newsletters, but very little on what do people do to get income. And it's tricky in an inflationary environment, but I think we are in kind of this cyclical disinflationary phase. So you can actually do pretty well with some of these. And one of our favorites is Bath and Body Works. The bonds are due in 2033, so about 10 years, and they yield about 8.8. And Ford, you can get, and Ford, I think, is an upgrade candidate. You can get 6.8% in 2031. There's some floaters, fixed to floaters from Capital One Financial, which is one of the better capital ratios. I think that one is money good. 5.4% current yield, and the bond is trading at about a 25% discount from face value. Even the mortgage-backed securities got a big yield over treasuries. The VMBS Vanguard ETF yields about 4.5% with a pretty short duration. So there's definitely some places to be. We actually think that because of the damage that's been done to the financial stocks, that there are some opportunities there. And I think Schwab looks really attractive. It got downgraded today and got hit again, but has a $68 price target. It's in the low 50s. I'll take 68 if that's where it's at in 6 months. I think they're uniquely positioned for a variety of reasons. So, there's my old saying is when there's chaos, there's opportunities. We've had plenty of chaos, so there are some definite opportunities out there. But I think it's important to remember that we're in a bear market. And it doesn't matter how smart the rallies are. Usually the best rallies do happen in bear markets, and they can suck people in. But my point is dollar cost average. If you say, gee, I think Schwab's a great buy, I agree with him. And there has been, by the way, lots of insider buying, which we like to see on Schwab. But I would do it gradually. Dollar cost average. Don't get in there all at once. Keep a high cash balance. Use kind of a barbell strategy of a lot in treasuries or government money funds, because frankly, nobody has seen the set of circumstances that we're going through right now before. So even me, with all these years of experience, it's new. In many ways, it's new terrain. I do recognize it as the aftermath of a massive bubble. So I think by being able to say that and recognize that, I have an advantage over those that are in denial about it, which I think is most people. But in general, I think it's don't get sucked in, don't be too aggressive, keep a lot of cash on hand for now.
And do you think there's reliable income opportunities out of oil, out of oil producers and oil pipeline companies, or do you think that those are too risky right now, considering where oil prices?
I absolutely agree with you. I don't think they're too risky. The risk got run out of them. They had two horrific bear markets. The first one started in 2014, and then in the spring of 20, when oil futures went negative and the MLPs went down 60, 70%. The midstream, the pipelines, and when I throw out MLPs, that's a shorthand for that. And a lot of those are, they're all stronger now than they were then. They've paid down debt. There's been a lot of insider buying in some of them. They're buying back their own shares, which is very unusual. They used to only raise capital, not retire capital. And it's just really hard to build a new pipeline. So if you've got an existing pipeline network, which something like Enterprise Products, which EPD, it's the class act. All they ever do is raise their distribution. It's been one of the greatest securities I've ever owned. And, it's not as cheap as it was back 3 years ago, but it's pretty darn cheap. And you get a 7.5% type of yield. And so, yes, I think you're exactly right. I'd much rather own something like that than even some of those corporate bonds that I was mentioning. But you can only have so much. You got to diversify. So, right now we're at about 10% in midstream, which is way more than the index. But a lot of people think that's too light. I think it's about right. If they get hit again, we'll bring it. We kind of max out at about 15% on midstream.
Yeah, I'm contrarian, and I'm just looking at like the commitment of traders and the posts on social media from a lot of money managers that are more short-term oriented. So short-term hedge fund traders, and it's just very bearish oil because recession, but we're getting pretty close to the cost of production for a lot of oil producers. So I think we're going to get close to a bottom in the next couple quarters.
I agree with you. We see those same statistics, and we see a lot of negativity, very, very low bullish positioning on. Basically, it's the hedge funds that picks up, the speculative open interest. So yes, I would agree, and I think that's why we're starting to see the market turn, because there's been a lot of hedging. And Wall Street Journal had a good article on that, these delta hedges, and so when the price goes down a lot, it gets around the put levels of the producers, where the producers about put as insurance. So then they have to sell futures to hedge that, so it can create added selling pressure. That's what can really create kind of a final flush out bottom. But once you've done that, then it can play going the other way. And then you've also got the SPR, which needs to be replenished. And you do have China reopening, which is about 1.5 million barrels of additional demand versus last year. India grows about 500,000 barrels a day every single year. So I just think we're going to get a very extreme shortage of oil, and we could easily see triple-digit prices again later this year, even if we have a recession. In fact, that maybe could trigger the recession, be kind of the final catalyst for one, if we get really a vertical move in oil and probably natural gas in its wake.
Yeah, I agree with everything you said, except I don't think Biden's going to refill the SPR. I think he just issued the press release. I think whoever's in the White House after Biden in 2024 or 2025 will be in charge of refilling the Strategic Petroleum Reserve. I don't think Biden wants to do that with his environmental base.
Well, they said they were going to do it when it was below 70, but they didn't seem to act on it. So you're probably right. My feeling all along is they were going to blow it. Apparently, their sale price is like $96 a barrel. I mean, they could be heroes by going in there and covering that short position now. But yeah, I agree with you. There's just an awful lot of hubris in our political leadership these days.
Yeah, I've lived right outside of Washington, D.C. for over 20 years, and the levels of hypocrisy here are astoundingly high. So there's ESG lobbyists here, and their adult kids are driving around $150,000 luxury SUVs that are not hybrids and and not electric vehicles. And so it would not surprise me. I mean, Biden actually approved the Willow Project in Alaska for ConocoPhillips. So I'm sure that pissed off his environmentalists and ESG base. So there's a lot of like flip-flopping here in DC and a lot of hypocrisy.
If you took hypocrisy out of DC, I'm not sure there'd be anything left.
Oh, yeah, yep. Unfortunately, that is true. Well, there's a lot of waste, fraud, corruption, and abuse. That's the new normal here. There's a bull market in corruption here.
Raging one.
Well, David, I really enjoyed our conversation today. We have to definitely have you back on again in a few months. It was a lot of great analysis there and some good income stock picks for our listeners. If my listeners want to follow you on Twitter, take a look at your newsletter, the Haymaker Newsletter, how do they do so?
Just go to Haymaker at Substack, and I just would request that they subscribe. We can't do that for them. Even if you email us, you get to subscribe on your own, but it's free. So it's, as I always say, it's everybody's favorite price. And we also do a Friday highlight reel, which is kind of the summary of the week, things that we found particularly interesting, some of which we've talked about today. So yeah, it's pretty easy to follow us.
And your book, Bubble 3.0, where can people buy that?
Well, for that one, if you really want a hard copy, send us an email. We do have a supply of those. We'll get it to you. But you can go to Substack and get the digital version. You can go to Awesound, AWE_sound, to get the audio version of it. If you have problems, you can also email us at Substack or contact us at Substack, and we'll get you the book one way or the other.